Hello, Smart Money Cheap Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend Doug Heagren. Hey, Doug.
Hey, happy Friday again, Kirk.
Happy Friday. We're at it once again. Here to tell you everything that's going on in the world, and let's start with a few key pieces. And so, real quick, we just want to make note of this. I mean, everyone's probably heard it because we've nonstop since last week, but since our last show, Charlie Munger died, and I would give a moment of silence for him, but we're on a podcast, and that would be weird, and people would tune out. So we're not doing a moment of silence, but doing a hypothetical moment of silence. Imagine we're doing it in your head.
Do you want to do a moment of humming?
Yeah, okay, that's our moment of silence. That's the best we can do. Sorry, folks. Anyway, I did want to bring it up because Charlie Munger is one of the greatest investors of our era. There's quite a few people that deserve that moniker. Warren Buffett, his partner, being one of them, and have to say, his Poor Charlie's Almanac is a great read if you can find it. I don't know if you can get. I don't know what the price is to get them now on Amazon, but they're quite high. So just wanted to mention that if you have not heard of Charlie Munger, please read everything you can about him. What he writes is brilliant. He actually taught Warren Buffett's most valuable skill. And I want to talk about it here for a moment because I think it's really interesting to learn. So Warren learned his skill way back, and what he learned was basically what we would call like cigar butt investing, which is you find these assets that are dirt cheap. The businesses are marginal. They're not great businesses, but they're dirt cheap. And if you were to buy them and sell off the pieces, you'd make money. Like that's how cheap they are. So there's this concept of cigar butt investing, which kind of took hold in the 30s and the 40s, I believe. I don't know exactly. I think it was the 30s. But anyway, so Warren learned that, and he thought, well, we'd get a marginal business at a great price. And what Charlie taught him is it's much better to have a great business at a reasonable price than a reasonable business at a great price. Now think of that, right? Like what he's saying is just because you're buying things at a reasonable price doesn't make it a reasonable investment. You be much better off if you're investing in great businesses that come at a reasonable price. Now, obviously, that doesn't come around all that often, right? Because great businesses rarely go for reasonable prices. They continue to grow, and as long as they continue to grow, then their numbers should keep increasing, right? You think of the big tech stocks that have driven massive performance in the last 20 years or 15 years, 20, whatever it is. But massive growth, right? They were overvalued in the tech bubble, and then they burst, and then eventually they came back. I'll use Microsoft as an example because they were one of the largest companies out there. And after the tech bubble, they burst. They were run by an abysmal CEO, Ballmer. I think he was just there because he was one of the first founders. So they're like, oh, let's give him a chance. And all the hedge fund manager buddies of mine that I used to talk to would tell me, well, here's what we do. We basically, and I don't know the numbers off the top of my head. He's like, we basically discount the company's cash flow by like $1 billion every year because we assume he's going to make some stupid acquisition and light that cash on fire. That was their discounting mechanism. We know he's going to do something stupid with about $1 billion and a half dollars every year. So we're going to discount that. And that's why the stock wasn't doing well. And then they changed CEOs. Nadella came in, done a great job, and the stock's boomed since. And the cash flows, everything he's done has been great. And so not sitting here saying you should buy Microsoft. That's not the point. And I'm certainly not giving advice. But I want to just point out that great companies, and the reason that Microsoft, the reason I'm mentioning is because they're a cash cow, right? You have to continue to buy Windows. You have to continue to buy Office because the whole world used it, the business world used it, right? And that's why it was a cash cow. It's like buying like an Altria, Philip Morris, or a cigarette company. People are going to smoke. It's like buying Diageo or Budweiser. Maybe not Budweiser. I know they had some problems, but you got these addictions, we call them, right? The addictions: gambling, smoking, drinking. Now we got social media. That's an addiction too. You think of these addictions; these are great businesses because people are legally addicted to them, right? Through whatever means, you could say, cigarettes and alcohol or legal addictions, right? Or gambling, right? So these are great businesses, right? As a business model, not specifically the companies, but as a model, right? It's a great business model. And if you can monopolize a market like Microsoft did, which is why I'm bringing them up, then you've got some great advantages, right? So if you're looking at a business, you're saying, well, what business would I own? Would I own a payday loan business, or would I own a company that supplies the whole world with software and there's no other competitors? I don't know. You choose, right? Which search engine are you going to use? You're going to use Yahoo or you're going to use Google? Like, which one's bigger? Well, Google's enormous. Even Microsoft can't break into Google's monopoly on search engine, right? So this is getting back. And by the way, don't take any of this as advice. Just disclaimer, so I don't get in trouble. But basically, if you think about these businesses, any sort of great business, right? And I could probably list 100 of these great businesses that you've heard of, been around for 100 years. They're going to be around for another 100. You take a great business, and if you can buy it at a reasonable price, it doesn't have to be a great price. It doesn't have to be bottomed out. It's trading at 100, then it went down to $1. If you're waiting for that, it's probably never going to happen, because great businesses will always be long-term sustainable as long as they don't do something insanely stupid. Like GE in the financial crisis, they were leveraging themselves up. AIG is another one, AAA rated. They leveraged themselves stupidly with derivatives. These examples are public, but those were great companies, and then they did something really stupid. So it doesn't mean that great companies can't fall. It just means that if you find a great company and you track it well enough and you know what's going on, if you have an opportunity to buy it at a reasonable price, right? So COVID, 2020, 2008, 2002, right around there. And probably in the next year or two, we'll see another crisis or two where companies are going to falter, and you're going to say, wow, this is a pretty reasonable price for this company. I'm going to buy some. You don't have to wait till it's a 50% discount. If it's 30%, that might be good enough, right? Depending on the stock. So that was one of the major lessons that Warren Buffett learned from Munger, and that's probably his prized possession in terms of knowledge base, because since he learned that, his performance skyrocketed in subsequent years. Now, a lot of that has something to do with property casualty insurers, which we don't get into enough in the show, but that's a great business model that no one really understands. But if you do understand it, you can make lots of money investing in those companies if you do it right. But point being is Warren Buffett figured out that lesson. All of a sudden, his performance took off. So kudos for Munger for giving him that knowledge. I think we all appreciate, because Warren Buffett's a national treasure, even if he does have the best PR around, and he's not a folksy old guy. He's a ruthless businessman, if you could tell from 2008 from some of the deals he made. But we can all learn from him, and he's very gracious in educating the public, which I think is a great. That to me is the treasure, is Munger and Buffett's willingness to tell people about what they're doing and how they can be better investors, right? To take the people aside, but just the knowledge base is priceless. So, a moment of humming for Munger. I'm sure you're going to a better place. All right, that's a moment. So let's get into other stuff. So we got tons of stuff to talk about today. What do you want to start with, Doug? There's so much here.
Well, I did want to say something really quickly. I don't know, depending on where you go on Amazon, you can find Poor Charlie's Almanac for $75, or they've got copies out there for $30, hard copies. So, I don't know why you'd spend $75, but they also have it for audiobook. So just a recommendation if anybody is interested in getting it, because it would be a great listen to.
The original is at 85. Yeah, the original I think was $85.
Yeah. Well,
the Chinese version is 50. So,
that's okay. We all got to learn these new languages to be in a global marketplace. So, pick it. Get your Mandarin lesson on the side. Kirk, honestly, looking at things that out there right now, there's I think a lot of information that I've looked at in the past week is the indications that things are not as comfortable for people as they seem. And so I think we've got a number of charts that and things that we've kind of come up with that are showing the pressure that we've been talking about for several weeks on households and in businesses as well. But overall, things have gotten tight, and I think it's not surprising anybody. First of all, I think there was again, I don't know if it's correlated. I don't know if it's causated. I think I said this to you, Kirk, offline. Obviously, there's pressure on cash flows. There was a chart that came out here showing that retail sales declined in October. This would be the first time that retail sales had shown weakness or declined since March of 2023. So we've had a pretty strong amount of retail sales through the spring and summer and fall timeframe. We are coming into the holidays here when we start to generally see an uptick in retail purchases. We had talked a little bit a couple weeks ago about Black Friday and Cyber Tuesday, and the numbers there, kind of waiting to see what would happen. Again, don't know if it's correlated or causated, but we have talked about the impact of households and cash flow, and it just ironically, whether or not it's related, student loan payments resumed at the end of September. October comes and we see a sizable shift, whereas the month-over-month return, growth in retail, it went from going from in April month-over-month about 0.4. June was a little soft, and then it kind of steadily went up to month-over-month about 0.7, and then boom, off a cliff, and goes down about 0.2%, a 0.2% slump in retail sales right after student loan payments restarted. So I'm not sure, again, whether or not this is causative or correlated. I certainly would argue that it was correlated, but we clearly are, as expected, there's going to be a level of impact that you're going to have when all of a sudden something you haven't been paying on for several years all of a sudden comes back into the budget at a time, as we have discussed, where people have taken on, some people have certainly taken on a lot more or higher priced mortgage debt. Also seeing that, people have, had M2 money. That M2 money, we've shown the numbers from the Fed. Again, M2 money is all the money that's kind of out there in circulation. It's in savings accounts, et cetera. It is not, it's been exhausted. And I think that leads us to another chart that Fidelity actually just put out. It average 401k account balances over the last 5 years. The average 401k balance is up just $1,200 in the past 5 years. So there's a number of reasons for that. There's been distributions that are being taken out of this 401ks. I think it, has probably something to do with the allocation of what people are invested in 401ks. While the S&P 500 has been significant, has been fairly strong of the same 5-year period. Kirk, you and I have talked ad nauseum about while yes, the S&P 500 has been strong. Yes, there's been about 7 to 10 stocks within the S&P 500 that have helped to push that performance. If we get away from those 7 stocks and then we start looking at small caps, mid caps, international, emerging markets, which is at one of its lowest returns now in relation to the S&P 500 in years, you start looking at the performance of value over that period of time. We have, not only do we have the pressure of people potentially needing that money, and they also talked about in this, they're starting to see an uptick in the number of loans that people are taking. The concern with loans, again, that's another cash flow issue, because when you take a loan, unless you take a loan from a 401k for the purpose of purchasing a house, which would give you 30 years to pay it back, assuming you're with that company 30 years, which is not quite as common as it used to be, you generally have to pay a 401k loan back in a 5-year window. Now, the max that you can take on loans in a 401k is either $50,000 or 50% of the value of the portfolio, whichever's less. So in other words, The most you're going to be able to get as a loan against a 401k is $50,000. Now, paying that back over the next 5 years is a cash flow drain. All of a sudden, that's a little bit less in your paycheck. All of those little splinters, those little paper cuts in cash flow have an impact on what's remaining to the household bottom line. The other thing too is just like credit cards, and maybe even more impactful to credit cards. I'd say this is more like HELOCs. The interest rate that's charged on a 401k loan is a lot more like in a HELOC, directly tied to the interest rates that are charged by the Fed. So, a lot of these 401ks will charge the Fed funds rate or prime, and they'll charge that plus 2. Well, if you look at what prime is right now, and I didn't look at it recently, but where it had been, and you add 2 percentage points on top of it, it means that a lot of these 401k loans now, Kirk, are charging. You have gone from maybe 5, 6, 7% up to over 10%. Okay, to repay them. So you've got a 10% interest rate on a loan that's due back within 5 years. One other problem, as I said, a lot of people don't stay at jobs for 30 years or more. Heck, the new trend over the last generation is to not stay at jobs probably longer than 2 years. Change jobs, best way to get a raise. If you leave the job, and again, if we're running into a potential recession and we start getting job losses, where it's not just going to another job, it's actually, I don't have a job. Well, unfortunately, at the time of the termination of employment, that loan must be repaid immediately, and or you're going to have an immediate distribution. It becomes income to you, and that income to you now creates a tax burden. Add that on to all of the other the variables, again, cash flow, and now you've got a tax debt again. So taking these loans, I know it's and I kind of want to do a little bit of a segue here, kind of a high horse thing. A lot of people will look and say to the 401k as an access to capital solution. I strongly caution it because of the things that I've mentioned: the higher interest rates, the payback terms, as well as the tax potential impact. But the other issue that you have to face with the 401k loan is that in most cases, and I've heard this story before. People say, well, if I take the loan, I'm paying myself interest. You're not paying yourself interest. You're paying interest back to the 401k, but they're taking the entire amount of money that you took the loan against and often dropping it into a collateral account that earns nothing. So during the time in which you have that money, you lose the opportunity cost of what that growth could be. And again, I don't know, 5-year period, the markets could be terrible. It might be a good thing, but most of the time, we think about retirement, we think about growing your money, that could be, an average return of, 2, 3, 5, 10% a year that you've lost during the time they were paying it. So it's actually turns out to be a lot of phantom costs that are very expensive. So I don't recommend it. But as I get back to the point here, over 5 years, seeing 401k averages grow just $1,200. Again, it's an allocation issue because we have seen growth in the markets is really, really concentrated in a very, very small portion of high-performing stocks. It's also a savings issue and a cash flow issue. And I think, again, it's another sign of things to note within the over economy. But also, I'll leave it on this and then I'll turn it back to Kirk. I saw someone post the other day. They were talking about college planning. They said, you know what, you should build up enough money, put money into the 529 so that, for your child. And then you'll have $26,000 that you can then give to that child over a 15-year period for the 529. And then don't use it. You start a Roth, and all of a sudden, this child in the next, the next 35 years is going to have, or 40 years, will have 1.4 million. And I looked at the numbers. I was like, all right, save this amount. You can have 1.4 million. I did the assumptions I did the calculation on it. They were assuming a 10.5% rate of return on that money the entire time. Now, since 2000, the average rate of return on the S&P 500 has been about 7.5. The actual has been about 6.5. Now, if you use that 6.5 number, 1.4 isn't happening. The actual number will be 114,000 on that saved money. So again, be very careful of, when you're thinking about these assumptions and growth and the real impact of asset allocation, if you're not managing it, the returns that people are out there promising you are not going to happen. That comes back to risk. That comes back to knowing what you're invested in. And it comes back to making sure that you take very seriously the impact of losses. I'll turn it back to you, Kirk, because I know there's other things we can go on, but I want to give you a chance to chat too.
No, I mean, this is good. And it brings up a topic that every once in a while we had a call this week, and frequently we have these calls with new potential clients, and this comes up a lot. And it's probably one of my least favorite topics because most investors have been conditioned to do this. So, and I'll talk about it here for a minute, and then we'll get into some more charts. And the topic is this: a lot of investors, like prospective clients that come talk to us, they say, "Well, what are your returns? Show me your returns. Like what and I get where they're coming from, right? They're asking me because they want to know, like, how have you done? The problem is it's a bad question, right? Here's why. You can ask it in a different way, but when you're asking for actual returns, first of all, people in our industry can't really tell you that, because it's not like every client is the same, and there's a lot of variables, and so we're not even allowed to tell you that. First of all, so if somebody's telling you that, either they're lying to you, or there's some people who can because they have a fund and they're like, oh, I've got a sheet and it's and they go through certain standards so they can. But for most advisors that are not running their own fund, you can't really say that. And if you do, most people are just kind of lying to you. But I do want to point this out because it's a bad question anyway, even if we could tell you, right? Because what you're asking for is you're asking, well, all right, well, you got this amount and this other advisor got this amount, so I'm going to choose the one with the higher amount. Well, it's a terrible analysis, right? Because one advisor might have been in bonds, the other might have been in stocks, and it doesn't really matter, right? Because they're not asking, what did you invest in? They're asking, what were your numbers? Now, a better way to ask that, right? And this is any advisor, it's not just us, but any advisor you're thinking of working with. The better question to ask is this: how did you think about 2020? Like, how did you manage that going in, and how did you manage it going out? Tell me about your process. That's a better question to ask, because the process is going to help you understand where their head was at. If you ask their performance, well, they could have been lucky. They could have been all in cash because they're switching from this to this, and this market crash, like, oh, I'm just going to keep it in cash. There could be so many reasons why that happened, right? And you don't know unless you ask the question, right? So if they say, well, I got 5% in 2020. Okay, what did you do? How did you get to that number, right? What was your process of getting there? Because if the process was, well, I was just indexing, I was all in the S&P 500. I'm like, great. Well, the S&P 500 got 7% this year, but it also went down like 35% or some crazy number. So if you're not understanding the pathway, the number is irrelevant, right? Because the last 3 years, the market has basically gone sideways. Now, depending on when you look at it, could be up, could be down, but it's basically gone sideways for that period. It's gone big swings. And 2022 was rough for a lot of people. 2023, everyone's celebrating, but you haven't really gotten any progress from 2021. I think December was the peak, somewhere thereabouts. But the peak, we haven't really gone past that. So we really haven't made progress. And so the question to ask is not really about the numbers, because the numbers are really irrelevant, right? Because you could say, oh, I did great this year. And they were down like 50% last year, but they're up 50% this year. Well, that's still horrible, right? Like that's not a great outcome. So, and asking a 3-year return or 5-year return is not any easier, right? Because then there's tons of questions that go in there, and you don't have the data as an investor to analyze the advisor, right? So the better way to analyze it is, all right, so 2020 COVID hit. Tell me about your process. What were you doing going in? What were you doing going out? What were you doing in the moment, right? How did you handle that? That is a better question, because what you want to know is how is this person thinking? Now, if the person just says, well, I'm an indexer, so I didn't do anything. Okay, that's a good data point, right? Maybe that's a valuable data point to you. I would look at that and say, all right, next, because it means the person's not thinking. But there are a lot of people who use indexing as a philosophy, so I'm not chastising them. I'm just saying it's different from mine, right? So you might want somebody who has a certain style. So you might say, well, my style is buy and hold, right? Or my style is more action oriented and trading oriented. So during 2020, we sold off and then we shorted the market or whatever, however they say it is, right? But you want to back test and look at it and say, okay, does this make sense? Is this the kind of person that I'm comfortable with, right? Because I think a lot of people would say, well, I didn't know what happened and nobody could have predicted that. And I would argue, yeah, it's not about predicting, right? It's about preparing. So, yes, nobody could predict that, but you could be prepared for it. So if their excuse is, well, nobody could predict that, and so we just buy and hold. Okay, well, that's somebody who's not really actively managing it, and their philosophy is buy and forget or buy and hope or all these things. And look, for some people, it's fine. But if you're hiring you could do that yourself. You don't need to hire somebody to do that. You don't need to hire an indexer. You're just paying money. You're just lighting money on fire. So if you want to hire an advisor, you need somebody who actually knows what they're doing, somebody who's managing risk and other things. But you want to understand how they're thinking, because then you can make a good decision about whether it makes sense to work with them or not, right? So we're talking about mental modeling of how to make these decisions, right? So same thing we talk about in the show occasionally, like attorneys. Like, how do you pick a good attorney? I don't know. How do you know their skill? You have no idea. Questions like, how would you think about this example? How would you think about this? Like, if this happened, how would you handle this? Like, so talking through scenario-based thinking, that's a great way to see what kind of a thinker they are, because that's ultimately what you need. You need somebody who's agile, who's adaptable, right? Because if you just hire somebody who's an indexer, and what if we go into like, the 30s where we had the Great Depression, and somebody's like, well, I'm just going to wait till it comes back. Okay, well, Japan took 30 years to come back. 30, I think I don't know if they exceeded the peak, but they're right around the former peak in 1990. So we're looking at what, 33 years, 34 years? 34 years, just about. So are you willing to wait 34 years to get your money back, to buy and hold, buy and hope? It's not my philosophy. I think that's stupid, but it's not for everybody, right? Everyone's got their own philosophy. So you just need to make sure you understand how they think. So then when it happens, you can react and say, oh, now I understand, because you were buy and hold and the market went down 60% and you're just going to hold. Okay. That's an informed decision you can make because you were comfortable with that. Now, if you'd rather not lose 50% and you want somebody who's managing risk, obviously that's our bailiwick, and you talk to somebody like me, right? So you need to find somebody who you can understand how they think and you're comfortable with how they think, not the numbers. The numbers are not a great indicator. There are plenty of portfolio managers that do great in up markets and they do terrible in down markets. All that means is they're taking a lot more risk. And in 2000 in March of 2009, if you wanted to take high risk, that might have been a good time to do it, right? Because the markets bottomed out and then they went up. But taking a lot of risk in, December of 2007, probably not a great idea, right? So you just need to understand like how they're thinking and how does this align with what you want from your own portfolio. So I just wanted to kind of talk about that. I think it's really important. I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today. I did want to touch on a few other things that Doug mentioned. So one here is this chart I just saw yesterday, which I thought was pretty good, which is a comparison of growth versus value. Now, what you'll see here, and the listeners just tag along, you can go to the website or YouTube to watch the videos. But what it's doing is comparing the Russell 100 growth, Russell 100 value. So basically comparing growth to value and the returns over time. And what you'll notice is There's the returns for growth, returns for value, and then there's the margin of difference, right? And so if you see the green, that means growth outperformed. The red means value outperformed. And what you'll notice in some of the mostly in the bad years, is when value outperformed, right? 2000, value outperformed 29% over growth. Value was actually up 7% when growth was down 22. 2021, growth was down 20%, value was only down 5, right? So you can look at those and say, wow, that'd be a great time to be in value, right? Or 2008, it was actually, I'm not surprised at this, but 2008 was basically the same. Growth was down 38%, value was down 36%. So only a 1.6% difference. But if you look at 2020, growth outperformed value by 35%. This year to date, as of whatever it was, 2 days ago, growth has outperformed value by 30%. Now, that should tell you something. Now, it doesn't mean anything specifically, but it should tell you, like, all right, this is kind of an outsized return. I should be cautious here. For example, 98 and 99, 1998, 99 to be specific, growth outperformed value 23% and 25%. Much, much higher than normal. And so when you see 2020, well, we know why that happened, because basically COVID. So I kind of discount that year because it was a mess. It's just some years you just got to take with a grain of salt. But 2023, that's interesting. Growth is up 35%, value is up 5.8, or almost 36%. Well, you can attribute most of that to those 7 stocks, those 7 tech stocks primarily, right? And they're up on average 55% between the two, and they do have an impact on the indexes. So I want to bring this up just to point out the difference in what's going on. So if you have a portfolio and you're like, why am I not up like 36%? Well, it's because you're not in all tech stocks, which is a good thing, right? You don't want to be on all tech stocks. There's times you can do it, but in general, you just want to be careful because you can put yourself in a very challenging situation. I want to also touch on 2 more things. I hand it back to Doug because we want to talk about mortgages and things of that nature. And Doug was nice enough to send us some good charts. So I do want to point out this one chart here, which is the S&P 500. So if you want to know what happened in the last, I think this is 2 years. This last 6 months. So in the last 6 months, basically the index peaked out in late July, and then we sold off going into October, and then now we're back to those recent highs. Now, are these all-time highs? No, but we're not far from the all-time highs. If you actually look at the S&P 500, we are we're about 5% away from all-time highs in the S&P 500. That's not far. And yet people are talking about a recession. They're talking about, basically companies are giving warnings for earnings, and we're close to all-time highs. Why do you think that's happening? Well, I want to talk about this one. Let's see if I can find it here. Basically, there's a big disconnect between the public and, let's see, I don't love this chart, but I want to bring it up just to kind of use it as a proving point. So this is the Financial Times, and they surveyed economists, and there's a big disconnect between basically economists and I think it's the public, if I'm not mistaken. But anyway, there's a big disconnect, and we've been talking about it in the show for a while. And so
market expectations, Kirk. So it's between economists and market expectations.
Right. So the public market expectations. So if we think about what's going on out there right now, so what's going on is the Federal Reserve is saying, you know what, we got a glide path. We're not going to lower rates until the end of next year, or January of 25, somewhere thereabouts. Okay. The market's like, yeah, we just don't believe you. We think it's going to go down probably in the next few months. There's a high probability that the rates are going to drop in the next few months. And according to this, in all of 24, people are somehow divided between 50 and even 1.5% of decline, 50 basis points to 1.5%. Well, Okay, that's interesting. But what I'll harken back to this, right? The Federal Reserve came out, and not to say I believe them, and we wouldn't be on the same page there. I think a lot of what they do is basically PR. But if you go back to like 2021, they pretty much said, all right, we're going to start raising rates in 22. The market peaked in December of 21. People were like, yeah, whatever, I'll worry about that in January. January came and the market started selling like hotcakes. Everyone was selling, and the market was down between 20 and 30%. In some cases, 30-year treasuries, I think, are down like 54% from the peak, which is crazy to think about. Guaranteed 30-year treasuries are down 54%. So if you think bonds are safe, think again. But my point is that nobody reacted until it actually happened. And all throughout that time, throughout the next 2 years, what the market said was, well, in 6 months, they're going to stop and they're going to lower rates. In 6 months, they're going to stop and lower rates. For 2 years straight, they said that. What happened? Rates kept going up. They kept going up until they stopped right around where they are now, which is what the Fed was predicting all along, is that, yeah, we're probably going to look right around here. And there are some good bond managers that have actually predicted it would be about 5.5 would be the stopping point, which is right around where it is. So something to think about when you're looking at market expectations. Technically, the market is always right because price is always correct, right? You could be thinking, well, this should happen. Shoulda, woulda, coulda, didn't, right? Should has no place in the market. So price is always right. But you do have to keep in mind that the market is always looking out 6 months and they're saying, well, in 6 months, this is going to happen. Well, they're not believing the Fed. And they're thinking everything's roses and rainbows. We're going to be all set. Nothing bad is going to happen. Yet earnings are starting to turn around. Jobs are starting to turn around. Inflation is more or less static where it is. Internationally, things don't look good in certain countries. Let's say the outlook is not great, right? It doesn't mean that they're going to have a crash tomorrow, but when you have a lot of the smart people in the room saying we're probably going to have a recession in the next 6 months, I tend to side with them over the general consensus of investors, because the general consensus of investors is dumb, right? And I don't mean they're stupid. I mean, in general, it's not a thinking crowd, right? It's emotional. And also, you've got a lot of institutional money that has nothing to do with emotion. They're like, well, this year we're going to put in this quarter, we're going to put in $1 billion into the index. And next quarter, we're going to put in $500 million. And the quarter after that, we're going to do this. It doesn't matter what the market's doing. They're just doing it, right? It's an unemotional decision. It's not a thinking decision. So that's why I call it a dumb decision, right? It's because it's not done intelligently. Hedge funds, they do it intelligently. Mutual fund managers, they do it intelligently. But as a collective, it's not a collective intelligence, right? It's a collective, all right, all together, we agree that the price should be X, right? But is that accurate? Well, I think we've seen the last 2 years for bonds, it's not. And bonds are typically the smart people in the room. So it kind of gets me to wonder, like, are people just addicted to this crack, this Fed crack of we're going to lower rates and print money? And I think we are. I think everyone's just lazy. Value investors have not done well in the last 20 years because it's easy just to buy big tech and just let it ride. And value investors, there's some great companies out there, but no one puts money there because, hey, it's so easy to buy big tech, right? And so people have stopped thinking, is my point. So we've gone from an old paradigm to a new paradigm, and we're in the new paradigm, and people haven't realized it because they're not thinking. Why did we have a global financial crisis in 2008? It's because people stopped thinking about real estate. Oh, yeah, it always goes up. Don't worry about it. It never goes down. But what if it does? It never happens. Don't worry about it. We didn't even account for that. That's how crashes happen, is when people stop thinking about important topics. So if you think, well, there's an assumption and it's too hard to do the work, so we'll leave that assumption where it is. Things change, right? So what are we missing? What is not being assessed? Well, people weren't assessing the risk of rates going up to 5%. So 30-year treasuries went down 54%. And if you still haven't sold, you got to get a head checked, right? It was very clear. The Fed was very clear about their intentions. I'm not saying you should sell now. That'd be really dumb. But the treasuries have actually come back down to the mid fours, I think, for the 10-year. So, my point is you have to think. And if you're looking at the difference between the thinking crowd and the non-thinking crowd, there's a big difference right now. And personally, I'm going to side with a thinking crowd. And I want to put myself in that bucket, but I don't want to be. I don't want to be. I want to be a little bit humble in the show. And what we're trying to teach the investors here is about how to think. We're not telling you what to think. We're telling you how to think. That's the premise of the show. Is how do you think about investing? This is it. Notice the big difference in people who are thoughtful about, like, well, the Fed just said we're not going to do anything, till the end of the year. Maybe they shorten it. Like, if there's a crash, they shorten it. But the whole market is saying, hey, don't worry about it. We're going to have a crash and you're going to shorten it up. Maybe. What if they don't? What if we have full employment? What if inflation is at 5-6%? Are you still going to drop it? Probably not, right? So there's so many factors. You don't know. It's too early. And so rather than just going along with the consensus, stop and think about it, right? Think about how this is going to impact your portfolio. I think it's really important as you go into the next year or two. If you're not doing any thinking, you could lose a lot of money, and that's what we're trying to get you to do, is to think here. All right, Doug, you want to take a few, and I'm going to take a few, and we'll wrap it up here.
Yeah, well, I just want to say one thing really quickly, as we've talked about before. The one person that is saying consistently, I don't know if I'm going to be lowering rates, is Jerome Powell. Have we sensed a pattern with what he says and what he does yet? And what's really, just a tiny bit, right? So what's really interesting is how the markets continue to completely ignore him. And he just came out a week or two ago, maybe it was 2 weeks ago, and said the same thing. It was, I'm not sure. I'm not giving you any indication that I'm going to be lowering rates, but the market keeps coming out and more. It's not just the general public, Kirk, but analysts are coming out repeating. I think all the analysts polled now believe that there is 100% chance that there's going to be a rate cut. 100%. Powell said, don't be so sure. I don't know. After 2 or 3 times, I think I'm going to side with
Boy who cried wolf.
Yep, absolutely. All right. So going back, you mentioned housing. Let's talk about housing for a second. I think it actually is nice because it segues back to one thing that I didn't mention. We talked about the retail decline before, because there was actually a breakdown in it that talked about how car sales fell 1.1% October from September. Furniture sales declined 2.0 during the same period. But the average monthly student loan payment is now averaging $500 a month. That's $6,000 a year that's now gone from the budgets of anybody that was carrying student loans. And again, depending on the family, it's actually more or less. But on top of the median home, on top of that was the median home payment for home buyers. It hit a record $3,000 a month. So that's a great segue, because we actually have another chart that's showing that the new monthly mortgage payments, and here it is, skyrocketed. Look at where the red line, I'm not watching your screen. Yep, you do have it up. Look at where the red line was from 2000 to 2020. Right before it really turned. I mean, we had our highest mortgage monthly payments, was right around, right before 2008. Right before the crash. Then it hit, ironically, right before 2020. Now, 2020 was COVID, but Kirk, if we can look back a little bit on that, I believe that you and many people were being conservative going into 2020, because there was a lot of signs going into 2020 that had nothing to do with COVID that said there were reasons to be cautious. 2020 was just the spark that lit the fumes. Okay. I mean, COVID was the spark that lit the fumes. But now look what's happened since 2020. Payments on homes. And again, this is that bullwhip effect of all of the things that occurred and the money injected in the system, putting increasing demand and lower rates, increasing the demand on real estate. But now that we've reversed that, and so we've not only taken and used the low cost of money to drive up the valuation of the homes that had to be purchased, you've now added on the rising interest rates since then. And so we've gone rapidly since 2020 from $1,400 a month to $3,000. I don't know about you, but quick math, I believe that's more than double. Okay. So this is significant. Now, this is just mortgage monthly payments. What I don't know is built into this, and it may be, is, and if it's not, this is something else that I think people need to be aware of, is mortgage monthly payments have gone up. But if that's just the amortized payment, okay, that doesn't take into consideration the add-on of increased cost due to insurance and taxes. And in some places, we talked about this, I think, a little bit last week, we've seen almost a 90% increase in the cost of insurance. Okay. We've seen people in certain states have to get assessments of up to $900 to $1,000 a month added on to their mortgage payment to make up for last year's taxes because the escrow was short. So now that also means that the new payment has to calculate what the new escrow is going to be based off of the now higher property tax amount, plus basically a back payment for the previous one. So, I mean, this 3,000 could incorporate all of that. I don't think it does. So now you might be looking at people going from, say, $2,000 to $4,000 a month on that. Add in $500 a month on student loans. And then, of course, you just want to get through this by having a drink. Well, guess what? Coffee is one of the most expensive things you can buy now. So, you might as well just drink the Baileys without the coffee. It's going to be cheaper. So I think that's a huge impact to budgets. We're seeing the thing there. And of course, now let's talk about inside of that. Let's talk about the business side of things. I don't know if you want to take this or you want me to, but we're looking at, Freddie Mac came out and talked about delinquency rates for multifamily. All right. So a lot of people went out there and invested in real estate, went out and, they're buying apartments. Some of these are institutional. Some of these people buying multifamily are just mom and pops trying to figure out a way to diversify and make money. And we're not even getting into the Airbnb side of things. We're looking at, again, massive potential delinquency rate of multifamily right after COVID. No kidding, right? Because during that period of time, basically, tenants got protected from paying rent. So if you were a multifamily, unit owner, and you were collecting rents, they didn't give you any reprieve on payment of your everyday expenses, your utilities, your mortgage, etc. So it put a lot of people, a lot of families, a lot of companies in serious financial jeopardy coming out of COVID. That's worked its way back down. Obviously, where we are right now in terms of what it's worked itself back to historically is still higher than it had been, say, from 2013 on. I think the telling sign here is just how rapidly, Kirk, we're seeing that it has spiked since November of 2022. That sharp increase is definitely an ominous sign that says, hey, this isn't just a slowly rising issue. This is a significant rising issue, which is a telltale sign of potentially some more issues that could be occurring there. And lastly, since real estate is a corporation, whether it's individually owned, under Schedule C or not, it is a segue into a conversation about corporations. And another chart that I found, look, we're starting to see more and more companies on the verge of bankruptcy. The proportion of U.S. bankruptcy candidates, and again, this is corporate here. I think, because we're not talking about individual bankruptcies. This looks like a corporate chart. But if you look back, and again, we've seen a degrading of health of companies that's been systematically growing since, in 1987. So we all know leverage and companies buying through leverage or whatever the reasons are, it's been going up a little bit. So bankruptcy candidates has significantly gone up since, 1987 and from roughly what looked to be maybe 10 to 20, 15 to 20% of companies is now probably borderline 40% of companies are bankruptcy candidates. Borderline companies to bankruptcy used to only cap out at maybe another 25%. So again, between bankruptcy candidates in 87 and borderline companies, only 50% of companies were at risk. That means 50% of companies were strong and healthy. Look what's happened. Now we are where we are. And the amount of companies that are strong and healthy, looking at this, maybe 10%. That means maybe 40 to 45% of companies are bankruptcy candidates. Another 50% of companies are borderline, and only 10% of companies are healthy. Okay. So, stock market keeps rising though, Kirk. These companies are great. They're doing just fine. Let's just keep swimming. The tide's still in.
Yeah, no, it's an important segue as we kind of talk about next year and where things are going. I want to touch on a few more things before we wrap it up. We Doug talked about this a little bit, but I just wanted to bring it up because I didn't show it, which is median home prices contracting sharply. So I want to bring this up because we've been talking about on the show pretty much all year about how real estate is defying expectations and gravity, quite frankly. And real estate skyrocketed after COVID, and it was still positive for the year up until somewhat recently, and now it's starting to decline. And I'm glad we're starting to see it because it's just abnormal that it was doing that. People are still buying, right, and people are still selling, but not as much, and the volume is a lot lower. And so I just wanted to show that this year could be the first year we're actually going to see a decline in median home prices. And hopefully that's a good sign because we do have to find a new equilibrium. We're not there yet. I'm not sure when we'll get there, but we're certainly not there now. I want to share this one chart, which is U.S. debt to GDP, nears 100% and set to rise in the future. I think this is telling because they're certainly not going to do any sort of the government isn't going to stop borrowing. That's for sure. They're trying to devalue the debt through inflation, and they're going to do that by borrowing more money. So I think that's just going to keep increasing, unfortunately. That segues into this other chart, which is the jobs chart, which Doug was nice enough to send. And I'm not going to spend too much time here, but just know that the jobs data that's been coming out in the last few months has shown that the economy overall is not adding jobs, but the government is. So the positive job numbers are mainly in the government. Now, here's a question. Okay, you look at this, you look at 2020, you look, wherever. The government employs a lot of people, right? I don't know what percentage of the payrolls are government, but a decent size amount of payrolls are government. Now, we've had a shortage of positions. We've had a shortage of people to fill positions for quite some time. And the government is hiring more people. Maybe the government should stop hiring people and let those people get into the private sector who actually need them. But yet the government keeps hiring more people. Why? It's insane. It's like, well, I shouldn't say it's like the politicians aren't thinking. We all know they don't have brains. But if you think about it, like I get the government filling the void. Like economics 101, they talk about that. Like, well, if there's a recession, the government will come in and employ people, and they'll fix the void. The problem is those people stay in government. So when things come back, there's no employees for those positions because they're all in the government and they're not going to leave because why would you leave? You're getting a normal salary plus a huge pension and benefits, and you don't actually have to work hard and all these other things. I'm not saying government employees don't work hard, but let's just say the standard is a lot lower in what the government expects you to do compared to what you're actually doing. So if you think about like how this works, this is going to continue to be a problem if the government keeps hiring more people, because those people are pretty much removed from the employment roles. They're not going back into the private sector unless they're getting paid a lot more money. And right now that's not happening because most businesses are trying to save money and they're trying to lower their costs, not raise them, right? If you're going to force McDonald's to pay $15 an hour for some snotty-nosed kid who doesn't know what they're doing instead of $7 an hour, McDonald's is going to say, well, we're just going to go buy a computer and get rid of that job because we can't afford to pay $15 an hour, and technology is such where they can do that. Great. We got a little kiosk. You put your information in and get the burger, just like they do at I'm trying to think of that burger place that my son goes to all the time. But anyway, like a lot of these places, they have a little kiosk. You put in the data and then they make the burger. You don't need someone at the counter. And that's what's happening. So you're starting to see technology remove more of these jobs. And if you want higher wages, you're just basically destroying more jobs because employers can't afford to pay them. And this will become a bigger and bigger problem over time. And people are going to the funny thing is people are going to start blaming the employers, like you're squeeze. Like this is why we get all these union strikes. You're not paying us enough. Well, actually, the problem isn't the employers. The problem is that they're printing money and devaluing the salary that you're getting. That's the problem, right? You think about it. Let's just use this framework and let Doug kind of wrap it up here with his where you can find about him. But think about it this way, right? For the last 20 years, the Federal Reserve has basically printed money, had low rates, which has caused asset prices to rise. Now, if you have assets, you've done fairly well. If you don't have assets, you've become more poor. That's the reality, right? Wages haven't kept up with inflation or asset prices. Wages have basically been stagnating for the last 20 years. So effectively, you're not getting paid anymore. Asset prices are worth more. If you don't have assets, you're more poor. So if you want to talk about like why is there a discrepancy between the rich and the poor, this is it. It couldn't be any simpler. It's the fact that they're printing money. It's causing inflation. It's causing asset prices to skyrocket. And if you don't have asset prices, you don't own a home, you don't have stock portfolio, you don't have 401k, you don't have assets that are appreciable, you're getting more poor. And so these union workers that are striking, you're not paying us enough. I'm not saying the company isn't giving them the right things. I don't know. I'm not in there deciding who's got what. But what I'm saying is the fact that we've seen a bunch of strikes lately of people, I'm not getting enough money. I wonder where that's coming from. Maybe because they don't have assets and the Federal Reserve has caused asset prices to skyrocket. Now, if you see a huge crash in asset prices, it'll become more equal. And I'm not saying that's the solution either, because that's not a great solution either. But the point is where it's coming from is important. The public thinks it's rich folk. Rich folk are taking advantage of the poor folk. That's not it. It's the fact that inflation is causing this discrepancy because of money printing. You can blame the Federal Reserve. You can blame the government. Both of them are at fault. But people want to blame rich folk. It's like, well, it's not the rich folks. It's not. They didn't do this. They were just smart enough to know how to take advantage of the situation. So they're just smarter in recognizing it, or lucky. Some of them are just lucky. Let's be honest. But the point being is, like, they benefited from this. They didn't cause it, but we're going to see a lot more. Let's just say there's going to be a lot more rich versus poor conversations in the next 5 years, because people are going to blame the rich folk, and they've started to. This is why all the CEOs have started hiring bodyguards, because they know what's coming. They're smart enough to realize, they see it. They're like, people aren't getting richer. The richer are, and the poor people are not. And at some point, they're going to come and have the French Revolution all over again. So hopefully it doesn't get to that, but we do need to equalize things, and that starts with inflation. Like, once you fix that, the problems kind of fix themselves over time. But the Federal Reserve and our politicians, the ones we've all voted for, have voted for this time and time again, and that's not going to stop because they feel like they can't stop. So, Doug, where can people find more about you?
I'm going to put an offer out there to people that are listening. If you have kids that are in high school and you're planning to send them to college, and cost of college is already getting increasingly and prohibitively expensive, a lot of people are asking, is it even worth it? Then find out before you go. And so we have a report, CAP report that you can run for families. You can go to our website, ProCollegePlanners.com, or reach out to us at info@ProCollegePlanners.com, and we'll get you access to a 5-minute report on what you can afford, what the schools you're looking at would cost compared to that. Maybe some suggestions on some schools that might fit within your budget. But again, know before you go. It's free. Take advantage of it. Again, if you have any questions, reach out to us, info@ProCollegePlanners.com.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.